Chapter 16 in economics, business costs, revenues and profits. For costs, cost is simply the amount spent in the cost of producing a goods or service. The amount spent to ensure that the product is made available. That is what cost is about. So costs, total fixed cost, TFC. Costs can be classified according to how they behave when output changes. Some production costs remain the same whatever the level of output, which are fixed. Example of fixed costs include rent, business rates, advertising, insurance premiums, interest payments, and research and development, R&D. These costs will not increase even if a firm produces more output. However, fixed costs will still have to be met if the firm produces nothing. Fixed costs are sometimes called overheads. So these costs, no matter what happens to our output, they have to be paid. They have to be incurred. We have to pay for them. They are overheads. So the running of the business cannot run, the running of the business will not be smooth without these overheads. So you produce or you don't produce, these things will be there for you to pay for. That is fixed cost. Is it clear? So fixed costs are costs that do not change as the level of output changes. Any question about that? So it is fixed and it's always horizontal. Let's see. Let's go down, please. Let's see. I think fixed cost is clear. It is fixed cost. It's horizontal line. Then total variable cost, TVC. These are production costs that change when the level of output changes. That is variable cost. Do you get it? This cost of production will change as the level of output change. So examples of variable costs are cost of raw materials, wages, cost of raw materials, wages. Both of them are always variable cost. So let's see what they said about here. Okay, packaging, fuel, labor, it's all the same. So if a firm produces nothing, variable cost will be zero. If the variable cost per unit is multiplied by the numbers of units produced, then we have our total variable cost. So if, as a firm, you do not produce anything, you will have a zero variable cost. That's the difference between variable cost and fixed cost. Even if you are not producing anything, the fixed cost remains what it is. You have to pay it. For variable cost, it depends on what you are producing. The output will determine your cost. Do you get it? So it starts from zero, then upward. So as output increases, your variable costs start increasing. Any question about that? Then we have the total cost. For total cost, it is fixed cost plus variable cost, TC plus VC. Clear? Or TF is the same as TFC or TVC. You can call it VC, you can call it TVC, you can call it FC, you can call it TFC. They are the same. So the cost of a firm producing all output over a period is called total cost. We talked about that already. So they could ask you in the exams, what is total cost? You can simply say FC plus VC. You're going to get your full mark. Clear? So look at the graph here. The total here we have about 40. Let's just go down. That's normal thing. Let's go down. Okay, we have average cost. For average cost, we call it AC. AC is TC divided by output. Total cost divided by the quantity of output or the quantity produced. That is ATC or AC is the same. Then we have the average cost curve. Yeah, okay. An average cost curve, are you there? The average cost of a business can be presented graphically. It is U-shaped. The ABC is always U-shaped. Why is it U-shaped? Here it said the average cost curve is U-shaped, which means that as output increases, the average cost will start falling to some extent. Then, if it passes the optimum level, it starts increasing again. That is when we start talking about these economies of scale. So for average, do you get what I'm just saying now or not? The average cost curve is U-shaped, which means as your level of output increases, your variable cost will start falling to some extent. So as soon as it passes that optimum level, then you start witnessing an increase in average cost of production or an increase in your variable cost of production. That brings about these economies of scale. So as soon as your average cost of production starts falling, you are witnessing economies of scale. Passing it would start being these economies of scale. Do you get my point, sir? So we have we have the curve here. At 300 units, are you there? At 300 units, you are still within the economies of scale. But going further to 400, you see that the output has increased more than what it used to be. The average cost of production starts increasing again. From 5, it came back to 10. So if you increase to 500, it goes to 20. So that's why it is U-shaped. It is U-shaped because it is expected that when your output increases, the variable cost would fall, which will allow you to be in economies of scale. Clear? Are you sure? All right. So go to total revenue. So there's no way we want to talk about cost of production without talking about what brings about that initiative of cost. So we wouldn't start incurring cost if there's no intention to make profit or intention to sell. So if we have incurred cost, if we have incurred this cost as a firm, it's because we want to sell the products that we have incurred cost on. You get what I'm saying here? So that means when total cost is achieved or is incurred, total revenue must be achieved. You get it? So total cost is clear, FC plus VC or TFC plus TVC. Therefore, total revenue is the amount of money you receive in the course of selling that product that you have made or produced. So that is your total revenue. Is it clear? So the formula for total revenue is price multiplied by the quantity sold. P multiplied by Q, PQ. Is it clear? So it's just about the formula. I think you know it. They made the example. You said if you wasn't training in the earlier example, okay, it's just an example, but what you need to know is the formula, which is TR is PQ. I think it's clear. So calculating profits. You know, I said total cost will be incurred. Total revenue must be achieved. So the difference between what is incurred and what is being achieved is the profits. So profit is total revenue minus total cost. Do you get profit here? So to calculate the profitability of a firm or to calculate the profit of a firm, you have to take away your cost from the revenue. Any question about that? Oh, we have the case study. They said if total cost is 35 million and output is 100 units, what is the average cost? They say AC is what? TC divided by Q. So TC is what here? 35 million divided by output of 100,000. So we don't have. So do it manually. We have 35 million divided by 100,000. This 1,000 has cancelled this 1,000. This 0 has cancelled this 0. We have 350. We have $350.
Yeah, so it's
Yes. Fair. Question 2. It said if variable cost is 10 per unit and fixed costs are 400,000, what is the total cost of producing 50,000 units? Note, let me have a paper, please. Okay. It said our variable cost is $10 per unit. Can you see from there? Our variable cost is $10 per unit. The output is 50,000 units. 50,000 units. Then we have our fixed cost, which is 400,000. That is fixed. It does not affect output. So we are told to find the TC. And TC is what? FC plus VC. So TC is what we are looking for. FC is 400,000 already, right? Plus VC. Now our VC is 10 multiplied by 50,000, which is 500,000. Is it 500,000? Multiplied by 50,000. Yes, 500,000. So that's 500,000. So total cost is 400,000 plus 500,000, which is 900,000. Is it clear? So that's done.